Hi, this is John McGowan. Welcome to the second episode of my series on macroeconomic topics. This episode deals with the history of money and banking, or rather, more appropriately, I present the bank creation mythology, kind of the standard bank creation mythology if you ask me. Many may be surprised to learn that the history of banking is tinged with fraud. Regarding the history of money, I actually don't have too much to say regarding that, because Wikipedia mentions the history of money predates recorded history. Wow! I had no idea. So since I don't know much about pre-recorded history, I'm going to start the bank creation mythology. In Europe, in the 14th or 15th century, when commodity money was all the rage. Commodity money is when the money itself is perceived to have intrinsic value. There are examples of shark teeth and cigarettes in prison, but the easiest way to understand commodity money is to think of gold and silver coins. With gold and silver coins as money, that money is worth at least as much as the gold or silver that is the coin. So that's commodity money. Now in medieval Europe, people started using commodity money, which helped promote economic activity because it has obvious advantages over barter, which I covered in my first episode. So now economic activity is picking up, people are using money, and before long they got tired of carrying around large sacks of gold and silver coins to make large transactions. Not only was it kind of burdensome, it was also dangerous having all that physical money in one place. So people then got the idea of, why don't I store my money in a storage vault and get a receipt for it? So those storage vault receipts, people started trading them as if they were money, showing that they actually had the gold or silver coins in a vault. They didn't need to have them in person. And here's a receipt that shows that the gold and silver coins are there. Commodity money leads to storage in vaults, which leads to people trading vault storage receipts. When people started trading these receipts, that's where the history of banking comes in. And as I mentioned, you'll be surprised to learn that the history of banking is tinged with fraud. Okay, let me get this straight one more time. You want me to give you a vault storage receipt even though you're not going to give me any gold? Why would I do that?
Yes, you give me the receipts, I make some moves, make some gold, and I'll pay you back in 1 year plus interest. And let me tell you what, if I don't pay you back, which is very unlikely, you can sell my house and use the gold to pay back my loan.
I don't know.
What can go wrong?
What can go wrong? Plenty. For starters, the proto-bank / vault is now issuing receipts for gold that isn't there. That's actually fraud. A logical consequence of that would be if everyone wanted their gold back at the same time, the proto-bank simply wouldn't have enough gold to repay them because it issued receipts that aren't backed by gold. Another thing that can go wrong is the bank issues these receipts without the gold, and it makes a loan backed by, say, somebody's house collateral. The commercial loan goes sour and the loan isn't repaid to the bank, and the collateral is insufficient to cover the amount of the loan. In that case, instead of making money, the bank actually loses money. So that can go wrong. Commercial banks do make loans that don't get repaid all the time. Of course, most of them do get repaid. But when a loan doesn't get repaid, sometimes it's the fault of the individual borrower due to some idiosyncratic reasons, such as they had a bad business model, or maybe, somebody stole money from them. But other times, the banks don't get repaid because there's a systemic issue, like the entire area is hurting, maybe due to low commodity prices, such as food or oil, or bad weather, or whatever. So if the entire area is hurting, that means the bank is going to be hurting, and that can cause stress for individual borrowers.
What good is money as a store of value? If my bank goes bankrupt, whenever hard times come, that's when I need the money the most.
Well, that certainly sounds like a problem. And in fact, since banking took hold in medieval Europe, bank failures have contributed significantly to the severity of economic downturns. However, times are different now, and you can trust banks. And here's why. Reason number one, that fraud situation is a thing of the past, along with commodity money. Banks are no longer committing fraud, they're no longer using commodity money. is an implied understanding that banks take deposits from their depositors, and with those deposits, they're going to make loans. They're no longer like a vault service commodity money, back in the 1400s. Welcome to modern banking. Reason number 2 is we now realize that the banking industry is dangerous. So banks are heavily regulated. There's bank examiners that look at banks to try to ensure that they're both safe and sound so that they don't cause bank failures. Reason number 3 is, should a run on a bank occur, that is, if all the depositors ask for their money at the same time, the central bank is there ready to take the bank's illiquid assets, i.e. their loans and mortgages. The bank can pledge those to the central bank, and the central bank will give them the necessary liquidity, i.e. cash, to meet their demands from depositors. So the bank can pledge loans to the central bank, get money from the central bank, and give it to their depositors. Reason number 4, which kind of gets at that systemic issue from the previous video, if there is a systemic risk and a whole region goes under, or the whole country is suffering a banking crisis, well, there's deposit insurance that's literally backed by the federal government that will make the depositors whole. Combination of all these things means that banking is a safe, reliable, productive part of the U.S. economy. Thank you for watching.